What's going on, traders? It's Tyler here. Welcome to another video with Trade with Tyler. Today we're going to be going over an educational video, trading for beginners. Please stay tuned and let me take you in this immersive journey. A couple topics that we will be discussing during this video is before you start trading, support and resistance, and trading with candlesticks. If you're a new trader or an advanced trader looking to update their skills, please stay tuned and let's get right into this. Before you start trading, Section 1. This section contains information that you need to know before you even start trading. That is absolutely crucial to every new trader and advanced trader. This is definitely something that you want to watch. So let's go ahead and get right into this. Welcome to Section 1, before you start trading. On these slides, we'll be going over two different topics on each section, and we'll also have pictures that will explain everything in detail for you. It'll give you that visual that you need to advance much faster and much easier. So let's get into this. Paragraph A. First, confirm that all of your trade rules that you set beforehand are met. Make sure to have basic trading rules before you start trading. Please look at the picture marked A. You can see that I do have 10 basic trading rules that you can use or modify into your own strategy, which I highly suggest doing. I would never suggest to anybody to trade without having at least 10 basic rules that you follow before every trade. And also, it's very important to keep track of your money management. And you could use your rules to help you keep track of your money management. These are just some basic rules here. You can get more advanced with your rules. Everybody's different. If you don't think you can manage money well, then have a specific money management rule. Only risk a certain percentage per trade, or get out in a certain percentage. You can be creative and think of whatever will work best for you. Everybody's going to be different. Everybody trades differently, but use this information and use it to your best advantage to craft your style. Watch how many more trades you win just by having simple trading rules. Very important. Paragraph B. You must be educated, prepared, ready to mitigate risk, and to learn from your failures. Always adapt and believe in accountability of your own actions. These are very important. This is something that you should live by if you plan to be a trader. You must always stay educated, and you must always be prepared. Even today for me, I still read books, I still research every day, I still study. Just because you have 10 years of experience doesn't mean you get the day off, because everybody else is working harder, so you cannot get left behind. It's very important. Always be ready to mitigate risk, never risk too much, and if you do have problems with money management, like I said, put it into your trading rules and make sure to follow your trading rules, and I guarantee you things will work out for you. Now please go ahead and look at picture B. You can see that successful traders are educated, are prepared, mitigate risk, learn from failure, always adapt, believe in accountability. And unsuccessful traders are uneducated. They wing it. They ignore risk. They constantly repeat their failures. They don't adapt. They believe in randomness. Mostly, they're gamblers. They're not traders. They don't take it seriously as a business, because to be a trader, you have to take it as a business. Remember, your cash is your product. So if you lose your cash, you lose your product. There's no way for you to make profits. You go out of business. Keep those in mind, and you'll do a lot better trading in the future. I have no doubt. So let's go ahead and head on to the next slide. Section 2. Support and resistance. This section contains vital information regarding support and resistance. Please go ahead and stay tuned and follow me to the next slide. And please don't forget, if you are enjoying this video, click that like button and click that subscribe button. And don't forget after the video to share it with your friends. Thank you so much. I really appreciate the support. Paragraph A. Support and resistance levels only show potential price areas of interest. But if markets don't respect them anymore, you need to update and adjust them in order to make the correct trading decisions. So please go ahead and take a look at picture A, and you can see that in these specific areas where it's green circle and the arrows are pointing in the direction, you can see that the bullish momentum held every time that it did hit down on that support level at 17.5. You can see in that green circle, as it dropped down, it found support the first time, came back up, went down, found support the second time, went back up, got rejected, came back down and had that third support line and got pushed up again. This is exactly what that paragraph means. You use them to find points of interest where it might potentially hit and use that with your other confluence factors when trading. But if the chart does break through that support level, then it's very important to update and adjust your support and resistance levels in order to make more correct trading decisions. Okay, let's move on. Paragraph B. Support and resistance levels just show potential, and it's usually impossible to make predictions about whether a level will hold or break. So what that means is use support and resistance as one of your confluence factors, but do not use it as your overall strategy. Make sure to use something like a VWAP, RSI. You gotta be researching, looking at fundamentals. Is there a news catalyst? You gotta have multiple confluence. You want confirmation on the charts. We'll talk about that in another video, but like I said, it's important to have confluence and just use support and resistance as another one of those confluence factors. And you can see it's very good indication, but if it does break through or break above, then that becomes obsolete for that time being. So it's not an absolute thing. Nothing is in trading, but that's definitely something you want to take into consideration. Go ahead and look at picture B, and you can see where it says strong support or minor resistance. You can see that's kind of where you could have made the prediction in the first place. For example, you can see right at the start of the chart where it dropped down, it finds support, it goes back up to that minor resistance on that strong support, it pushes back down, and then stalls right at where the previous strong support was. And that is what it means by giving you the prediction, giving you the indication that it's going to be reversing. But this is not something that you'd want to put your full force in. You wouldn't want to rely on just one simple confluence factor and put money on it. That's not a good idea. But obviously, if that's what you want to do, that's what you're going to do. But I'm just here to tell you that it's very important to have more confluence factors, but obviously support and resistance is gold and very useful when you confluence with other factors, because it can give you over a 50% chance just from that alone. So very important. Okay, so let's move on to the next slide. Section 3. Trading with candlesticks. In this section, we're going to be going over the basics of trading with candlesticks, how to read them, and how to understand them. Come along with me to the next slide. Paragraph A. Candlesticks are useful when trading as they show 4 price points, open, close, high, and low, throughout the period of the time the trader specifies. So for example, 1 minute, 3 minute, 15 minute, 30 minute, 45 minute, 1 hour, 4 hours, daily. It always has a high price, an open price, a closed price, and a low price. Please direct your attention to picture A. We can see on this dark shaded candle, this is a bearish candle example. So this would be for an example of going in a downtrend, what your candle would be representing in that time period. We can see at the top, at the very top of the wick, that would be your high price. So for example, you can look to the right and you can see at the top of the wicks on the red candles, those are your high price. You can see where it says open price on the dark shaded candle, that's where the price opened at. So you can look to your right on your chart and you can see those red candles. The very top of where the color started, that's where the price started. Now you can go ahead and look below open price where it says close price on the dark shaded candle again, and you can see that's where your price closed at. And then just below that you have your low price, which is wherever that wick is. So you can look at the right side chart again. You can see on the red candlesticks, wherever those wicks are in those red candles at the very bottom, that's where the lowest price was in that time period, whether it be 15-minute, 30-minute, 5-minute, whatever the case may be. That's how you read the candlesticks. And then for the opposite direction, if the trend was uptrend and it was bullish, you can look at the white shaded candle here, the bullish candle, and you can see the top of the wick would have been the high price, the top, the colored candle would have been the close price, the bottom of the colored candle would have been your open price, and the very bottom of the wick is your low price. You can take a look at the right side of the chart on the B area, and you can see the bottom of the wick on the green candles was the low price, and then below the bottom color shaded area is where the open price opened at on that specific candle, and at the top shaded color where it ends, that's where the price closed for that candle, and then the top wick is where the high price for that candle specifically was at. So that's how you read candlesticks. Let's move on. Paragraph B. Candlesticks show human emotion by visually representing the size of price moves with different colors. Red equals bearish, green equals bullish, or whatever specific colors you have on your charts. Traders use the candlesticks to make trading decisions based on regular occurring patterns that help forecast the short-term direction of the price. Please give your attention to picture B, and you can see where that has the arrow pointing at the green hammer. This is a perfect example for that last paragraph, because what it's explaining is that you use candlesticks to indicate where short-term direction in the price will move, and you can use this on different time frames. Now you can see one of the big things that you want to keep in mind with candlesticks is reversal candles are very strong. Traders use the candlesticks to make their trading decisions based on the patterns that forecast short-term price direction. So what that means is you can see how we were in a downtrend here, and then we had a reversal candle here, this hammer, which is a reversal candle, which would have gave some people an indication this might move higher. And then what they see, they seen it broke back up, came back down, retest, and then that would have been a chance for them to enter, reading the candlesticks. But you only do that with short term, and you only use this as another confluence factor. Just like with support and resistance, use candlesticks as another one of your confluence factors. Make sure to study up on reversal candles, and just know shooting star and hammers are two big ones. I will have a video on that later, so make sure to subscribe. Okay everybody, thank you for joining me today for this beginner's trading video. If this video did help you, please be sure to click that like button and subscribe for more videos just like this one. And please be sure to share it with all your friends on Facebook, Twitter, and StockTwits. I will see you later, and we'll be back for way more education and hardcore trading. Tyler out. I'll see you later. Have a wonderful day.